and you had 40 years of declining interest rates, 40 years of kind of steadily declining inflation. And so higher stock valuations, higher bond valuations, it's all kind of a positive feedback loop until it's not.
This is Kaiser Johnson with Liberty in Finance, and these are the Miles Franklin Weekly Specials for February 26th through March 4th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have 1-ounce gold Valcambi bars at only $59 over spot. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're delighted to have this returning guest, Lyn Alden, an investment analyst and student of all markets. She's head of Lyn Alden Investment Strategies at lynalden.com. Joins us again this Monday, February 26, 2024. Lyn, thanks for coming back on Liberty and Finance.
Happy to be here again. Thanks for having me.
Our viewers often request your return here because you've got such a well-respected following for your in-depth analysis and careful thought that really breaks open, makes things a lot more clear for people that can be otherwise quite mysterious. And frankly, it seems like a lot of the stuff that we hear on the mainstream financial press obscures more than clarifies the truth and the issues about what's going on. A couple of topics we'd like to touch on with your help are what's going on with petroleum and the oil price and the oil trend and the oil supply and demand risks that are present because of geopolitics, etc. And then also about the burgeoning U.S. debt and deficit and what that is affecting, what trends it's driving and is likely to continue to drive so that people can position themselves appropriately to not be hurt by the effects of that. So could we start with your current macro view of oil and what impact and interesting aspects of that you think that people should be aware of right now and the way that it's taking us?
Sure. It's a good set of questions. And I think, the way that I approach this is to look at it over multiple time frames so we can kind of start zoomed out and then zoom in. And so if we zoom out, oil and other commodities tend to go through certain capex cycles. And so, there's a period where there's, oversupply, prices are low, and so companies are not aggressively investing into bringing new production online, and demand keeps steadily growing over time, and existing reserves start to get thin, and eventually that results in more scarcity and more upward price pressure. But then it takes time for CapEx to be enticed to come into the space, and then it takes time for those projects to come online. And so you normally have a multi-year significant bull market until there's been kind of sufficient CapEx or sufficient demand destruction from the higher prices to reach kind of a new equilibrium. And then they kind of start that process over again where now there's oversupply because of all that lagged CapEx coming online, and you go through a period of lower prices, lower CapEx, and kind of start that cycle again. And that's a fairly long cycle. That's like a 15+ year cycle. Historically, it might be, a decade or two of kind of a bear market in commodities, and then a really good decade for a bull market in commodities, and kind of start that over again. And so that, we're kind of deep into a period where a lot of energy prices, a lot of commodity prices have been stagnant for a long period of time. They've had cyclical highs, they've had cyclical lows, but for example, we're lower in the oil price than we were about 15 years ago compared to that peak that it hit. And so overall, they've kind of been in that bear market range. The next factor to consider is that when shale oil came online, right? So prior to that, a lot of folks focus was on conventional oil production, but the combination of new technologies and low interest rates allowed for this kind of unprofitable rapid build out of U.S. shale. And a lot of that was not free cash flow positive when it was done. And that, the industry got punished for that. But over like the 10, 15 years of that happening, the global markets now kind of include shale as part of the baseline, right? So, we're probably not going to bring another amount of new shale oil on over the next 10 years that we brought on over the past 10 years, right? So that doesn't mean that U.S. oil production is going to collapse. It just means that the rate of upward change that the bulk of that is likely behind us. And so oil went through this long kind of consolidation. Then the past kind of 5+ years, 6-7 years even, in that whole kind of shale, the end, like the later portions of that shale period were very negative for pricing because that was kind of a rapid change in the supply side of the oil market. But that had the effect of now, oil's kind of a left for dead market. There's not a lot of capital that wants to be there. The capital that is there is telling oil companies, look, don't keep putting your profits into the ground. Return it to shareholders with dividends and buybacks and improving your balance sheet, kind of like solidify what you have. And so there's not a lot of rapid capex. And so I think going forward, putting aside the geopolitical concerns for a second, I think, that just on the capex cycle alone, we're probably due in the coming 5-10 years for rising energy prices on average, and more capex needed to bring supply online and to maintain existing supply to meet demand. But then when you kind of overlay on top of that the geopolitical issues, there's certain pockets of supply that could go offline pretty quickly. You could wake up to a headline and just there's disruption. So during the rise of shale oil, there's more surprises to the downside in the oil market that are possible to happen, whereas now we're in an era where there's more upside surprises that can happen. But even without those upside surprises, energy companies in general are pretty well positioned at current oil prices. They make decent profits. They're trading at low valuations. They have good balance sheets because they used a lot of these last few years of decent energy prices to kind of reinvest in their balance sheet. And so overall, I think that's from an investor standpoint, it's an interesting area. But then also from a risk standpoint, it's important to watch because obviously higher energy prices could disrupt things elsewhere in your portfolio or elsewhere in the economy.
I was curious, you mentioned about halfway through there the inclination of major oil producers recently, rather than sinking a bunch of money into the ground, returning it to shareholders, et cetera. Do you see any of that being due to the political climate that's basically telegraphing to all countries of the world, hey, we're going green, the future is electric, the future is not petroleum based anymore? What factor do you see that playing in all of this?
I think that's part of it. It's hard to quantify it, but it definitely shows up in the, when you analyze a company, what they're talking about. I think even if you excluded that for a second, just the sheer fact that shale was so unprofitable during its rise and companies that just kept plowing money back into new projects and never really became free cash flow positive were eventually punished for that. So I think, even aside from the ESG green stuff, I think there's a normalization. Basically, investors are tired of just lighting capital on fire and saying, look, if we're going to do a project, I want it to be profitable. I want you to, prioritize strengthening your balance sheet, returning cash, and really only invest when it really makes sense to do so, a higher hurdle for investment. But then on top of that, I think the market is less quick to adjust to changes because they have it strongly in their narrative that they need to invest elsewhere, that EVs are going to eat market share, that other energy, is going to come online, even though it's still a very tiny percentage and is expected to continue to be a very tiny percentage. And then also there's, when you're kind of calculating the risk of a new project versus paying dividends or buybacks, they have to consider things like windfall taxes or penalty tax or regulations assigned to them that they can't necessarily model. And whereas returning capital to shareholders is one of the lowest risk uses of capital. And so I think all of those factors are kind of coming together to make it definitely an area worth watching. Again, whether you're looking at it from an investor standpoint or a risk standpoint, kind of like how it could affect your other investments.
And there's two more aspects of this I'd like to probe with you. One is the rest of the world. And we've heard that, for example, all this talk of global climate change and greenhouse gases, et cetera. But when you get to the global summits where they discuss these things, the Western countries, the US and Europe, typically take on or are asked to take on the burdens of self-limiting sanctions or carbon payouts or different things, reducing consumption, et cetera. Meanwhile, you've got countries like China and others that are building, I don't know how many new coal-fired power plants and that sort of thing per month, et cetera. So it seems to be that the highest population portions of the world are still flat out pedal to the metal, trying to basically catch up to the last century of the lifestyle that has been enjoyed by the countries in the West that have been, consuming petrochemicals. So is it Is that another factor that you see driving continued demand going forward? Is this East-West imbalance? If you've got the politically correct West saying we're going to limit, but the East saying, well, we still haven't had it, and most of Africans, people still not electrified, et cetera.
Yeah, I think that's a huge factor. I think that's where the bulk of demand is going to come. It's going to come from the BRICS countries, the emerging market countries, the faster growing populations. And a lot of those countries, even though some of them consume a large amount of energy in absolute terms, it's still a very small ratio in per capita terms compared to the United States or Europe. So China, even though they're a very large consumer of all, energy and all commodities, on a per capita basis, it's still pretty modest. And so it's natural that a lot of those people want to eventually develop in a similar way that wealthier countries did in the past. We went through a big hydrocarbon cycle. Now it's somewhat less about energy growth and more about kind of productivity growth with that energy, but they still have that core energy growth to still continue for quite a bit. And I think that even as China maybe slows down in that regard, I think India is still on kind of the hockey stick, like upward ramping part of that. Hopefully Africa as well. Some of the countries there are still consuming very little. So I think that's a factor. We've also seen when push comes to shove, developed markets will step down, right? So I think the way that I phrase this generally is that there's been a problem between like engineering and optics, right? So politicians often manage for optics, whereas if you're an engineer, you actually have to make the system work. And so some of those green technologies have a role. I mean, solar panels are useful if you want to be off grid. Obviously, if you want to have space systems, there's use for that energy. The problem is when you put it into places where it's not optimal for, say, political reasons or things like that, rather than an engineer deciding this is the best place for this type of energy. And so when energy crises happen, narratives kind of shift because people get angry. And so, for example, during the European, natural gas crisis, when they abruptly lost their supply from Russia, you saw Germany, for example, pivot heavy into coal. And one of the downsides is too, so Europe was trying to push the green ESG stuff. The second they needed all that, right, as soon as they had to displace their Russian gas, they went, one, to coal, two, they went to LNG, so liquefied natural gas. Now, that's a finite market globally at any given time. They can build new capacity over time, but it's an expensive, slow process. And they basically said, look, we're going to outbid almost everybody else because we have to. We have the money and we have an energy crisis. So the countries that ended up suffering were like Pakistan and other frontier or developing countries that basically, they were going to get natural gas, but then they got outbid in that LNG by, Europeans that needed to fix an energy crisis. So a lot of that, kind of those kind of mismatch between optics and engineering, when push comes to shove, one is thrown out the window, and two, it's often not the country that made the error that gets punished for it. They get kind of displaced by them. And so there's a lot of factors there. We've
continued to see, you could call them unintended. One doesn't always know because one doesn't know the mind of the people who are imposing these sanctions. But anyway, what appear to be lateral thinking puzzles where you see a sanction put in place or some geopolitical decision or some political optic decision or narrative-driven decision put in place with the stated goal. And even sometimes the stated goal doesn't make sense, but you definitely will see quite often big effects and sometimes quite negative effects on others that seem to be, innocent bystanders in this. Okay, so you've talked to us about the macro supply and demand cycles, et cetera. It looks like we're likely to be, for the foreseeable future, in a strong environment for supporting higher petroleum and fossil fuel prices, perhaps because of the burgeoning demand, et cetera. What does that do to the overall concern that people are certainly having about inflation? Because it seems that in the past, we've seen that petroleum or energy in general is underlying so many other aspects of our economies that high energy prices tends to support higher prices everywhere else. How do you see the impact on inflation overall and price inflation, coming from this discussion on energy that we've been having? Yeah.
So, and to kind of clarify the energy point, it's not necessarily that I expect, for example, a huge bullish cycle right ahead. It's that I expect that the overall market is flat to up. and that there's more kind of risk to the upside than the downside. And so as that plays out, I think inflation is going to be similar in the sense that, I'm not expecting necessarily massive inflation by this time next year, but I do think that the average baseline level of inflation is going to remain higher than it was last decade on average, basically higher highs and higher lows, and that overall that the trend is basically at least mild surprises to the upside, and then of course certain geopolitical events or certain disruptions could cause major dislocations to the upside, either in energy prices or overall kind of inflation measures or both. And I think that there's somewhat of a push and pull there. So when we look at the role of technology deflation, for example, there's certain advancements in technology can make some areas cheaper, right? So TVs get cheaper, computers get cheaper, manufactured goods get cheaper. Now, AI can make certain white collar work cheaper because you're offloading some of that to a processor. Now you're competing with that on price, and so that can be disinflationary in certain categories, whereas other categories remain unaffected. And so I think that the energy side is going to be one of those at least relatively unaffected categories by some of those, rapid tech increases in the next, call it 5+ years. And so I think you could see bigger than normal gaps between different categories. Over the past decade, for example, things like healthcare, education, housing, all of that was inflating at a really rapid pace, where it was being offset in the CPI by electronics, manufactured goods, textiles, things like that. And I think if you could kind of run that over the next decade, I think you could see white collar labor, certain services, certain things like that be a little bit more disinflationary, whereas things like energy could be more significant contributors and kind of real world stuff. That kind of ties in also to reshoring some manufacturing, which is a very long and expensive process, and adds generally to prices. The world that we had over the past 30 years was one of rapid globalization. So, China reconnected with the rest of the world. All that Eastern labor connected to Western capital markets, and kind of that was a very disinflationary force and way more productive. Russia, the Soviet Union fell and opened up and connected to the rest of the world. They, their energy and materials connected to Europe. That was all kind of these separate systems coming together, which is disinflationary and generally productive, but it came at the cost of resilience. Everything's kind of all connected together globally, and so it only takes fairly modest geopolitical issues between, former enemies, and that gets thrown out the window. And so I think that we don't have that 30-year trend in front of us anymore. I think best case scenario would just kind of stay somewhat isolated. Worst case scenario, there's obviously more disruptions ahead. And so these are all kind of background inflationary forces. And then it just becomes a matter of how large are those relative to certain pockets of disinflation, like AI on white collar wages and things like that.
Yeah, there's a lot to explore there, because that can also talk about a huge dislocation of white collar workforce, unemployment, reduced earnings, etc., hard times. People have talked about perhaps a coming depression as greater than the Great Depression of the 1930s, and there was a lot of displacement there that happened, consolidation of family farms, etc. We've seen some parallels with that recently. Could you first explore with us the impact of an inflationary era at the same time as record debts and deficits?
Yeah, so overall, the debts and deficits are net inflationary, but again, there's other forces. And so the description I like to use is the 1940s, because when people think of inflation, they often think of the 70s. And there are some parallels to the 70s, including, for example, the risk of energy disruptions. But there's two major sources of money creation in an economy, in a fractional reserve economy. Either it's from bank lending, so fractional reserve bank lending, lending creates more deposits in the system, which then get used for more lending, or you run monetized fiscal deficits, and you have the kind of central bank kind of partially facilitating the spending of the government, and that kind of injects money into the system. And so in the 1970s, the bulk of new money creation was from lending. And it was because the baby boomers were entering their home buying years for like a 10, 15, 20-year stretch there. And that was a period of just more rapid credit growth because of that. And then they ran into, of course, energy constraints. So you had both sides of the coin. In the 1940s, you had a similar level of average inflation for the decade, but banks were barely lending at all. Instead, most of the new money creation was coming from very large fiscal deficits involved in the war, involved in building out manufacturing, involved in, even when the GIs came home, putting them through like college and technical schools and mortgage assistance and all that. That's all basically domestic and foreign kind of fiscal stimulus is getting monetized, increasing the overall money in the system and going around the banking sector. Or in many cases, the banking sector is forced to purchase a lot of those bonds to finance it. And so far in the 2020s, we're closer to the 1940s scenario, which is that our higher than normal period of money supply growth and our higher than normal inflation levels were not because of excessive bank lending. They were because of very large monetized fiscal deficits. The second point there is that when you look at the 70s, how do they slow down inflation? They got much tighter monetary policy. They raised rates, and that's effective because mostly what the Fed does is target the bank lending sector. So by increasing interest rates, they slow down the rate of bank lending, slow down the desire to borrow. And it does have the effect of increasing fiscal deficits because it increases the interest expense that the government pays. But back then, public debt was 30% of GDP, and most of the money supply was growing from the lending sector. So if you jack interest rates up to double digits, it is disinflationary. The problem is when you have a scenario like the 1940s or like a scenario today where you have 120% debt to GDP, when you raise interest rates, it does mildly slow down the bank lending. But that's not where the most money creation is coming from. Instead, it's coming from the deficit, and higher rates make the deficit even bigger. And so monetary policy tools are generally less effective at dealing with fiscal-driven inflation. And so overall, my base expectation for the next 5, 10, 15 years is continued very large deficits. Should those deficits result in liquidity problems in the treasury market or adjacent markets, the Federal Reserve is practically forced to come in and assist with those with liquidity injections, basically balance sheet expansion. And all of that is a net positive liquidity inflationary force that's more kind of industrial policy, more like the 1940s. And so when I kind of look forward, it's less that I see a depression in kind of the 1930 sense, and it's more like I see industrial policy in a similar way that the 1940s were. But it's a very different environment because you have older demographics. The spending is probably not getting as targeted as things back then. So back then it went to highways, it went to energy production, it went to manufacturing, whereas now a lot of these fiscal deficits are actually fueling consumption, but not really facilitating the production to meet that consumption. And so on average, I would expect, higher baseline inflation minus whatever we get from that AI component.
So this is very interesting because many of our clients and subscribers are being given what I think is fairly conventional advice from their financial planners and financial advisors based on the last 40 years or so. And if I hear you correctly, what you're saying is that that's not the best model that to be following, and that the next 10 years doesn't look like the last 40 years. Can you help us understand what people who want to position themselves to not be hurt as much as they may be if they follow what's perhaps the most common retail advice that they're getting, what they should be thinking about as far as where to position themselves for success in the next decade?
Right. So when we think of the typical portfolio, like the 60-40 stock bond portfolio, that's a portfolio that's entirely geared around the expectation of disinflation. So it's expecting inflation to be low and asset prices to be pretty positive. And so during that 40 years, stocks were mostly up. During recessions where they went down, bond yields would usually go down, so bond prices would go up. And you had 40 years of declining interest rates, 40 years of kind of steadily declining inflation. And so higher stock valuations, higher bond valuations, it's all kind of a positive feedback loop until it's not. And so now that, interest rates have kind of hit zero and bounced off zero, and now that equity valuations have kind of inclined higher for 40 years, I think a lot of the juice has been squeezed out of that positioning. And then a lot of the kind of statistics around that are basically recency bias, looking at the past 40 years and just expecting them to continue without really having a reason for why they would continue. And so I think, the way that I approach it is to say, okay, I still want to hold equities, I still want to hold other assets, but I want to have more inflation protection within a typical portfolio. I don't want to be geared entirely around the idea that there's going to be another 10, 20, 30, 40 years of structural disinflation. And so instead of that kind of 60-40 stock bond portfolio, say, okay, we have a stock section. The bond section could be tweaked. It could be, for example, shorter duration, cash equivalents, T-bills, money markets, things like that, tips. You can put gold in place of some of the bonds in that portfolio. And you can break out a section that's kind of geared towards inflation. So, for example, energy producers, other types of real assets, maybe copper producers, for example, diversified industrial plays, things that are more in line with that inflation scenario. And so instead of having the entire portfolio geared towards disinflation, you've got that more balanced mix of some assets that prefer disinflation and growth, some assets that do well in those more stagflationary, inflationary environments. The cash equivalents can hold well against market sell-offs, and you have kind of various debasement hedges. I think that more balanced multi-asset portfolio makes more sense when you have that less of that Goldilocks scenario.
You mentioned a couple of times BRICS. Can you turn your attention to that before we wrap to give us your big picture view of what you think the impact will be on not only the global balance of power financially, but also specifically on retirement age people in the U.S. who have, again, been basing, and a lot of their advisors basing a lot of their models and their assumptions and everything on the last 40 years rather than the next decade or two?
Yeah, I think it makes sense to expect average higher domestic inflation because of industrial policy. The rest of the world sees that, and they see a couple of variables. One is that they see the weaponization of the dollar. So they say our reserves are freezable if we're not on the right side of the U.S. And two, they're saying that, when push comes to shove, they're going to print the money. And so holding low yielding debt that is not, for our national savings from their perspective is not really like a, sound, prudent financial policy to follow. Now, there are significant network effects with the dollar, right? So I think some people overstate how quickly BRICS can change from that model. And, as an example, any country that prices its global contracts in dollars and collects dollars, there's a lot of things they can do with the dollars. The U.S. has the deepest and most diversified capital market, so they can put it into virtually any equity they want. They can put it into the very deep and liquid bond market. They can put it into private equity. They can put it into real estate. There's a lot of liquidity and size and diversity they can put those assets into. Whereas, for example, if Russia and India make bilateral trade agreement so that Russia sells oil to India in rupees, and Russia starts accumulating a surplus of rupees, there's only so many things that they want to do with rupees. Eventually they say, okay, we have too many rupees now. Can you pay us in something else? And that's an example that's come up a number of times. And then, if they make a deal with China, if they make a deal with Brazil, if Brazil makes a deal with India, or Brazil makes a deal with China, you have these kind of bilateral trade agreements, and none of them have the individual liquidity or depth of markets that the U.S. has. And so they have to figure out how to tie those together better. The only one that even comes close would be China, because there's so many things you can buy if you have Chinese currency, but then they have closed capital markets. And so they have way less liquidity and way less, kind of security in that regard. And so the problem that BRICS it goes through is that they have to deal with this kind of piecemeal, weaker network effect of multiple different currencies. They don't really want to put their currencies together in the same way that the Eurozone has. And so, there's kind of a mismatch of solutions. Some of the bigger ones do these bilateral trade agreements to kind of reduce their reliance on dollars on the margin. They can put surplus reserves into gold. They've been doing that because that gives them an unfreezable, debasement-resistant asset that they can hold. You've even seen some smaller countries do things like mine Bitcoin or accumulate Bitcoin. So El Salvador, the Kingdom of Bhutan, we're seeing mining now in the Emirates. So some of them are kind of saying, okay, here's this asset that we can hold. We can also make global payments with it. So they're kind of exploring that around the details of small positions. So all these kind of ways to say, okay, how can we circumvent the dollar? How can we build bridges between our different bilateral trade things to make this more efficient. Things like mBridge allows kind of, this kind of the CBDC version of their global trade settlement to kind of all interconnect rather than all go through dollars, all go through New York. But that's kind of the slow grinding piecemeal process that's playing out. And around the margins, it reduces treasury demand. It makes that so that more U.S. deficits have to be financed by domestic sources. So either the banking system or non-bank financial entities or the Federal Reserve in some cases. And that's overall, it adds to the average inflationary backdrop that we can expect.
It's going to be an interesting time ahead. If people want to follow your work more closely, how should they get connected?
Sure, I'm at lynalden.com. People can find me there. I'm also on Twitter at Lyn Alden Contact. Thank you.
Lyn, we're always grateful for your presence here on Liberty and Finance, and on behalf of all of our viewers and subscribers, thanks for joining us.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for February 26th through March 4th, 2024, while supplies last. First, we feature backdated 1-ounce silver maples at $3.39 over spot. We also have 1-ounce Gold Valcambi bars at only $59 over spot. And finally, we're offering our choice 1-ounce Palladium bars at just $119 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.